money is coming back from all these sources. It comes to the trustee. It comes to the insurance company. It's theirs. It is not your money.
You've also said, Nelson, often that you don't have to be rich to create your own system that can handle all of your needs for finance. Can you expand on that?
Because it's all proportional. Quite often, people with a large amount of monetary value have a more difficult time catching on this than the everyday person. The everyday person can see the value of it and start on a scale that's appropriate for them. And it doesn't take long to get rid of one of those indebtedness out there. And once you get that done, it snowballs in a hurry. Like I said, it took me 13 years to get rid of the banks, but so what? 13 years are going to go by anyway. But once you get rid of this, it's such a different life.
I also appreciate you sharing, because on the opposite side, when we spoke about the arrival syndrome, you have a very interesting story about a prominent attorney that you had met with while trying to introduce the concept of becoming your own banker. Would you mind sharing that story?
Well, you're going to have to prime me there a little bit. He was one of the most natural aviators I've ever seen. I helped teach him to fly, and he just took a look by nature. It was wonderful. Among other things, my son's a West Pointer, and this guy was a West Pointer. Then he went to law school here in Alabama. So I was introducing him to the concept of banking through life insurance, but he had that locked mind because of the partial information by what goes on out there in the media. And I'm a very patient fella. Now, if my wife were here and heard me say that in front of you guys, she would giggle because she doesn't think I'm patient. But I spent 3 years trying to teach this guy this concept. That's patience or stupidity, one or the other. I can't decide which. But anyway, he kept saying that you're using smoke and mirrors here. That was his phrase, smoke and mirrors. Well, after a while, a fella does catch on, and I did. I quit talking to him about banking through life insurance, but I did finance his airplane. I lent him money on an airplane for 5 years. I took that chain of payments monthly and bought the same thing I was going to sell him. I made the same commission as if I sold it to him. But whether he'll ever catch on to this or not, I don't know, and I don't care.
Nelson, I think that connects perfectly to what you describe in your book as the characters in the financial play. We have the depositor, the borrower, the banker, and the bank owner. Can you speak to each one of those characters?
Well, again, where do we start there to get this hemmed up? Shakespeare gave us a clue years ago. He said, all the world is a stage and all the people are actors thereon. But my observation in the financial world, when it comes to the subject of finance, they don't even know what the play is about. But worse than that, they get the characters in the play mixed up. But money is a necessity out there to acquire the items of wealth that Paul Cleveland pointed out so brilliantly in the video that we all know about. Money is the medium of exchange whereby we acquire them. All right, now somebody's got to be the banker out there. When you go to a card game or so forth, now I don't play cards. They still have 52 in a deck. Anyway, somebody's got to be the banker.
Right.
All right, same thing here. What's happening with dividend paying whole life insurance? You subscribe to the idea of buying this stuff, you got to pay a premium. Now, that's real money because that's money that you worked for or you provided goods for.
Right.
All right. That's backed up by activity that is taking place. Well, in this same climate, financial climate, though, that we have the funny money out there created by central bankers that is really not money at all. It's just conversation. The life insurance company has got to put that money to work. They put it to work in various and sundry places. And in my book, I point out that one of the places they put it is shopping centers and real estate developments and so forth. Another place they might put it to work is mortgages, like house mortgages, residential mortgages, things of that nature. And another one is that they do make it possible to lend money to you. In fact, if you read the contract, it tells you that you have available 100% of what can be lent from your policy at any one time. Well, if that's true, which it is, it's total control. Well, the life insurance company really is your trustee. One of our practitioners put this together brilliantly several years ago. He says, this is just like a trust agreement. A trust has a grantor, it has a trustee, it has a beneficiary. The grantor creates the trust. Up until that time, it did not exist.
Right.
When you buy a life insurance policy, you're creating a new business from scratch that never existed. Now, the trustee becomes the owner of that property. The trustee becomes the owner of that property. The trustee has got to put it to work to carry out the provisions of the trust. Why did the person create this thing in the first place? Well, he can put it to work in any number of places, but one of the places he can put it to work is with the grantor. All right, so money comes in from these various and sundry places. Oh, by the way, now in the life insurance company, there's any number of places where they might put this money to work. But I want to establish a hierarchy of places. And so I just restricted it to 3 places, shopping centers and real estate developments, mortgages, and the policyholder. Look at the financial statement of any life insurance company.
Right.
Show you very plainly that it's an instrument that have a guaranteed payback schedule. I said guaranteed payback schedule. Now, that's not true of things called universal life. That's not true of things called variable life. But these are products of the brains of Harvard MBAs that it won't hold up over a period of time. They're not taking into consideration what really happens in an economy out there because of central banking. Let's just restrict it to those 3. Now, they put money into things like, okay, the hierarchy I need to address. In that hierarchy of those 3 things, shopping centers and real estate developments rank number 3. The mortgages outrank them. Well, why? There is an element of risk in real estate developments and shopping centers and so forth. Have you ever seen a defunct shopping center?
Yes.
Have you ever seen see-through buildings?
Yes.
If on your way back to Birmingham Airport, going down the expressway, look over to the left, and there's 9 buildings out there, last count that I made, that's totally empty. They're see-through buildings. There's nobody in there. There haven't been anybody there for years and years. Well, that's bad. So that's a little bit of element of risk there. Well, when you have a risk and so forth, that requires more expertise in the home office of life insurance companies to oversee that kind of activity, make sure that they hold these sort of things to a minimum. Yeah, risk assessment, that's good, yeah. So money goes out, money comes back into the trustee, the insurance company. Now, let's go to the next level, mortgages. I don't see any real risk in conventional mortgages. Now, this subprime stuff like The Big Short describes, good grief, unbelievable what goes on there. What a book. I have not seen the movie. I can't see how you could come up with a movie that would equal the book. But anyway, look, in a conventional mortgage, we putting 20% down, we'll say, and every time you make a payment on the mortgage, the strength of the lender increases. You owe less and less, and they have a mortgage on the whole cotton picking work. I don't see any real risk there at all. Well, what does it take at the home office to oversee that, administer that kind of activity? Well, slightly above minimum wage. Well, let's go to number 1, the policyholder. Look, that's a fully guaranteed loan. That's the safest loan that the life insurance company can make.
They know that there's no possibility of
It's
the borrower
impossible to
defaulting.
lose on it, and so forth.
Right.
So again, what kind of home office expertise does it take there? Well, again, slightly above minimum wage. Well, so money is coming back from all these sources. It comes to the trustee. It comes to the insurance company. It's theirs. It is not your money. All right. Now, in the diagram that I constructed, at the bottom of the circle, there's death claims. Every once in a while, somebody dies. It doesn't happen all that often. but it's going to happen. It's got to come out of the general resources of the insurance company. They've got to pay the overhead of the employees of the insurance company, and of all things, they have to pay commissions to these agents. They won't work unless they get paid for. It's amazing. No sense of humor at all. Okay. Well, so you have income from the sources on the right side of the diagram from those three places. You have expenses from death claims. You have expenses from operating the expenses of the company. Well, you can make projections of this sort of thing over a long period of time and be pretty accurate, but there can be aberrations out there. The projection of income could be a time where it didn't measure up. They can be pretty accurate with the death claims. They can be fairly accurate with the cost of operating the company. But the combination of those three could produce a negative result at one particular time, or a not so favorable, we'll say. Remember that we got some characters into play here. The actuaries are the one that compute all this sort of stuff, because everything that you do in life starts with engineering.
Right.
The car you drive used to be lines on a piece of paper. If the production folks don't do what the engineers said to do, you don't have a car.
Right.
But they did. You get the one right off the assembly line, I get the next one right behind you. Same make, same model, same color, same equipment. My car, your car, they're identical. Go ahead and tell me your car and my car will perform identically during the lifetime of the car.
It's not possible.
It's impossible.
Right.
42 miles from where we're sitting right now is the Talladega Raceway. And, some of those cars out there don't last 500 miles. You can't blame that on the manufacturer. It's how you drive it and keep it up. So forth. Because put it back at the you and me level, everybody around knows somebody today that could get 250,000 miles out of a car with no trouble at all.
I think that speaks to your teaching point about the policy owner's behavior is far more critical than the behavior of the insurance company.
That's just it. And there's some folks that can't get 50,000 miles out of a car before they worn it out. Well, the same thing happens here, that what the insurance company is doing is one thing, but how you manage your affairs through this marvelous medium is another altogether. And of course, the primary thing is don't make foolish purchases. And by all means, when you do make purchases, you are borrowing from the policy, and you got to pay it back. You can't steal the peas. That's just all there is to it. Years ago, Kevin Lesko is a chiropractor up in eastern Pennsylvania, and he had got all this figured out on his own over a period of about 2 years by calling life insurance companies and such. Now, it was rudimentary, but he had all the essentials. And so when my book came out, he was just ecstatic that it corroborated what he had discovered. And so as a result, we had a think tank session and put him on the program to tell us about his experience with it. Well, I've gone there to eastern Pennsylvania a lot of times. Kevin lives fairly close to that area. And so he shows up at the seminar, and he brought his 8-year-old daughter, Natalie. And he introduces Natalie to me, and that 8-year-old kid looked me square in the eye and says, "You can't steal the peas from your grocery store."
Oh, bright young lady.
And that 8-year-old kid sat there all day long with a legal pad taking notes. And about 10 days later, I got a letter from her. She had cleaned it all up, got it all on one page about this seminar she went to in Lancaster, Pennsylvania. See, I did find it. In Lancaster, Pennsylvania, that taught her how to be her own banker, and she laid down cold.
Wow.
And so she signed off, "Love, Natalie. P.S. You can't steal the peas." Well, if an 8-year-old can catch on to this to that degree, because that's the key to it all. Your best customer that you should have in your banking system is you, and you don't want to be lending money to a fool. So, if you want to kill the best business in the world, have at it. but it's not going to be on my hands. I warned you.